Peruvian Central Bank University Extension course, Economic Terms, Part 2. My name is Leonardo Palacín Bustamante, and today we'll see 10 more terms frequently used in this important exam. Number 1, forward guidance. It is a communication tool used by central banks to provide the public with information about future monetary policy intentions, especially regarding interest rates. By signaling their likely actions, central banks aim to influence expectations and stabilize markets. Examples: the Federal Reserve used forward guidance during the 2008 financial crisis, announcing it would keep interest rates near zero for an extended period. This forward guidance reassured investors and businesses, encouraging them to make long-term investments with the expectation of low borrowing costs. Number 2, the European Central Bank issued forward guidance in 2020, indicating that it would consider raising rates only if inflation remained above 2% for a sustained period. This forward guidance helped keep market expectations stable during uncertain economic times. Quantitative easing, QE. QE is a monetary policy in which central banks purchase government securities and other assets to increase the money supply and encourage lending and investment. Examples: number 1, during the COVID-19 pandemic, the Bank of England implemented quantitative easing by purchasing £450 billion worth of government bonds. This QE measure helped inject liquidity into the economy, supporting businesses and households during a severe economic downturn. Number 2, the Federal Reserve used QE in the aftermath of the 2008 financial crisis, buying large amounts of mortgage-backed securities to stabilize financial markets. This QE policy helped lower long-term interest rates and boost economic recovery. Overshooting. It refers to a situation where the price of an asset or currency temporarily goes beyond its equilibrium level before adjusting back to a stable level. Examples: in 1992, the British pound experienced overshooting when speculation forced it out of the European exchange rate mechanism. After initially plummeting, the pound stabilized at a lower level, showing how overshooting can occur in volatile market conditions. Number 2, when the Federal Reserve unexpectedly raised interest rates, the US dollar initially rose sharply due to overshooting, as investors adjusted to the news. However, the dollar's value gradually corrected to reflect long-term economic fundamentals. Zero lower bound. ZLB is a situation where nominal interest rates are at or near zero, limiting the central bank's ability to use interest rate cuts to stimulate the economy further. Examples: Japan has been grappling with a zero lower bound since the 1990s, with interest rates at zero or near zero for decades. As a result of the ZLB, the Bank of Japan had to rely on unconventional measures, like quantitative easing, to encourage growth. During the 2008 financial crisis, the Federal Reserve reached the zero lower bound after reducing interest rates to near zero. Facing the ZLB, the Fed turned to quantitative easing and forward guidance to support the US economy. Outright monetary transactions, OMT. It is a program by the Central Bank of Europe, the European Central Bank, ECB, that allows it to buy government bonds of Eurozone countries facing economic difficulties to stabilize their economies. Examples: in 2012, the ECB introduced outright monetary transactions to address the Eurozone debt crisis. Although no actual OMT purchases were made, the mere existence of the OMT program helped reassure markets and reduce borrowing costs for struggling countries like Spain and Italy. Greece faced with borrowing costs in the Eurozone, but the potential for outright monetary transactions by the ECB calmed investors. The OMT program provided a backstop for the Greek economy, even though no direct OMT actions were taken. The Sharpe ratio. It measures the risk-adjusted return for an investment by dividing the excess return over a risk-free rate by the investment's standard deviation. A higher Sharpe ratio indicates better risk-adjusted returns. Examples. Number one, a mutual fund manager evaluates two portfolios, one with a Sharpe ratio of 1.5 and another with a Sharpe ratio of 0.8. The portfolio with a higher Sharpe ratio is chosen as it provides a better return relative to its risk. Number two, an investor considering different asset classes looks at the Sharpe ratio for each. The portfolio with the highest Sharpe ratio is selected, as it offers the most favorable risk-return balance. Core inflation. It measures the overall increase in prices excluding volatile items like food and energy to provide a clearer view of long-term inflation trends. Examples. Number one, the US Federal Reserve monitors core inflation, which excludes food and energy prices to guide interest rate decisions. If core inflation rises, it may signal persistent inflationary pressures and lead to potential rate hikes. The Bank of England's report shows that overall inflation is at 4%, while core inflation is only 2%. This lower core inflation indicates that price increases are largely due to temporary factors like energy prices rather than broad-based economic pressure. Swap. It is a financial derivative where two parties exchange cash flows or other financial instruments, commonly used to manage risks related to interest rates or currency fluctuations. Examples. One, a company with a variable rate loan enters into an interest rate swap with a bank. Through the swap, the company receives a fixed rate and pays a variable rate, stabilizing its interest payments. A US company with euro-denominated debt uses a currency swap to exchange euro payments for dollar payments, reducing its exposure to currency risk. Underlying asset. It is a financial instrument or item upon which a derivative contract is based, such as a stock, bond, commodity, or currency. Examples. In an option contract on Apple stock, Apple shares serve as the underlying asset. The value of the option depends on fluctuations in the stock price of the underlying asset. 2. A futures contract on gold has gold as the underlying asset. The contract's value will rise or fall depending on the market price of gold, which is the underlying asset. Margin call. It is a demand from a broker to an investor to deposit additional funds or securities to cover potential losses. This happens when the value of the investor's margin account, where they've borrowed funds from the broker to invest, falls below a certain level, known as the maintenance margin. Example number one, after a steep market dip, Sarah gets a margin call from her broker, prompting her to deposit extra funds to maintain her position in tech stocks. During volatile trading, Tom receives a margin call and must quickly add funds to prevent his leveraged investments from being automatically liquidated. This is English applied to economics. Thank you.